All right, here we go. Welcome, everyone. Good morning, good evening, good afternoon to those calling from around the world. Super excited for this webinar and this particularly a very important topic as we support the clean energy transition with entrepreneurs is financial innovation. So, unlocking private capital for climate financing in the global south through guarantees. And so just a quick introduction to myself. My name is Andrew Chang. I'm the CEO of New Energy Nexus, where it's the world's leading ecosystem, clean energy ecosystem builder. Our vision is to support 100% clean energy for 100% of the people in the shortest time possible. Our mission is to support diverse entrepreneurs and drive innovation and build equity in the global clean energy economy. So we've had over 2 decades of experience working with startups, working with entrepreneurs all around the world. We have teams embedded across 12 countries, and we're able to support not only with capital, but with tools, connections, and networks to be able to help clean energy entrepreneurs be successful. To date, we've had over 1,500 startups supported. We have, which equates to around 10,400 entrepreneurs. We've distributed $84 million in capital, which has catalyzed to $4.7 billion in follow-on funding and capital. We've created 8,300 green jobs as a result of our programs. So one of the cross-cutting themes at New Energy Nexus is an important pillar in financial innovation. It's crucial in making, particularly in the global south, making capital more affordable in these markets. And financial innovation is actually just as important as the technology innovation in these markets. So it's really important that we cover these topics today. We have a great cast of characters today. We have our guest of honor joining us today, Abendra Bhatt, who's the co-founder and managing director of C-Kinetics, board member of Seekers Finance. And I will pass it over to UB for a quick introduction. UB?
Yeah, thank you, Andrew. Good morning to everyone, and maybe good afternoon and good evening as well, depending on where all people are dialing in from. Andrew, thank you for that warm welcome. As Andrew mentioned, I work with C-Kinetics. We are a sustainability advisory and investment firm. We've been working very, very closely in mainstream several of the distributed energy interventions and helping intermediate capital, leveraging blended finance structures in this space. We have intermediated north of about $600 million of blended finance through lines of credit, have helped set up 6 guarantees across several of these segments over the last decade. So quite excited about this conversation, been partnering with New Energy Nexus on several initiatives, including our own sustainability finance vehicle, Seekers Finance, which was one of the early sustainability financiers in India. And we continue to kind of evolve and grow in this space. So would love to share from those learnings, but also from the broader work we have been doing jointly with Jennifer and Christina. Thank you, and look forward to the conversation.
Thank you, UB. Appreciate that. Next up, we have Christina Borsum, our Chief Financial Officer. Christina?
Yes, thank you, Andrew. My name is Christina. I've been with New Energy Nexus for over 9 years now. Been part of the internationalization, really, of New Energy Nexus, what used to be the California Clean Energy Fund. I'm a reformed banker. I come out of banking, so this topic is really near and dear to my heart. I'm not an energy technology wonk by trade, but as Andrew already mentioned, I absolutely believe that getting finance into the system is so important for the clean energy transition everywhere, and what products can we leverage and bring to market to accelerate the transition. Guarantees, which we're going to talk about, play a huge role, but there's so many other sort of emerging structures, and there's also a need for first movers. So that's what we've been doing at New Energy Nexus in small pockets. So using concessionary financing that we can deploy for something like a sustainable energy bond and investment into Seekers Finance. We've worked on a microgrid facility We've worked on an early stage fund investing in clean energy entrepreneurs in Indonesia. And basically, when the market picks up, then New Energy Nexus financial innovation work is done. That's sort of been the guiding principle. And I think I'll throw it to Jennifer with that.
Thanks, Christina. Hi, everyone. I'm Jennifer Wong, Director of Financial Innovation at Energy Nexus. Like Christina, I'm a recovering, I don't think that's the word you used, but a recovering banker. I was in investment banking for many years in New York, Los Angeles, and London, and then moved over into the corporate space, worked in a startup for a while, started my own startup. I am now based in Nashville, Tennessee, so in the US South. This work is really, really exciting to me because I get to put my hugely capitalist chops to work for a different type of capitalist system. And really just focusing on not just how we can get more money into this space, but make sure it gets to the right people that are doing the work on the ground. So I think, should I just head straight into what we want to talk
One
about?
moment, Jennifer. Yeah, no, I know we're just quickly on housekeeping items. Well, first of all, thanks for the introduction, guys. Housekeeping, really quick. This is going to be recorded. We're going to be sharing the slides as well as the recording after. There is a Q&A function. If you guys want to ask any questions, we'll leave the last 15, 20 minutes for that. So I will be moderating that. And yeah, so I think we are good to go. So Jennifer, over to you.
Okay. Thanks. So I'm just going to share some kind of introductory thoughts on why guarantees, what we're working on in guarantees, and then we're going to have time later for questions. So please be thinking about questions if you want to have a more of an interactive discussion at the end as well. So just starting with what we're talking about here in terms of generally the climate finance landscape, the climate finance context. 2024 has seen actually like record capital flows into climate finance. CPI said it's about $2 trillion in 2024. However, 4 to 8 trillion per year is needed. I'm going to speed through this because I think a lot of the audience knows these numbers. Just 12%, though, of that finance is getting to emerging markets outside of China. So that's a really small percentage. So there are still some big barriers happening right now. Affordable capital is scarce. Yet there is lots of capital in the world, 450 trillion in global capital. A lot of that is sitting in things like retirement funds, pension funds, bank deposits, insurance companies. So a lot of our task, if we want to get more money into emerging markets, into the global south, which is where obviously the impact of climate change is being felt significantly, but also a lot of the innovation and where a lot of the dirty energy is coming from for the rest of the decade or the rest of the century. The global south needs catalytic forms of capital, right? Not just straight capital, but capital that can be leveraged. So things like these guarantees, like grants, like first lost capital in the form of equity or debt in blended structures. So what are some of the challenges? Why is this capital not getting into the global south? Why is it being concentrated in the US, Europe, and China? So I think it really breaks down into systemic risk and risk that's perceived as well. So systemic risk in the countries and the regions that are not necessarily deal specific, fewer reliable regulatory networks and frameworks that will actually incentivize the transition and incentivize the build out of renewable energy systems, existing energy markets that are still encumbered by these legacy systems, legacy relationships, legacy incentives, right? It's really hard to change those frameworks. And then also, if we're talking about emerging sectors, there are other emerging sectors out there that clean energy is competing with that may be less capital intensive, may seem like they're more mainstream in terms of the technology that is being presented and developed. So the technology may be just more understood there. And along with that comes potentially more financial exits to point to versus in the clean energy space. When we're talking about government and philanthropic support, there's competition with what may be considered more urgent development priorities. So things like health, education, livelihoods, youth unemployment, jobs, that type of stuff. So far, there's been a very heavy reliance on public sector and philanthropic funding. So can we expand that pool? Of course, that's what this call is about. And then, of course, this comes back to the perceived risk. There's a risk and return mismatch between the deals that are seeking funding and then the investment committee requirements of at least the current universe of potential investors, things like scale, things, again, coming back to the systemic risks, the perceived risk of the systemic risks. So we can move on to the next slide, Andrew. Thanks. So how do guarantees play a role here? How can guarantees play that catalytic role? So guarantees can cover the risks that these financiers are unwilling to take on. So things like credit risk, political risk, revenue risk, and we'll talk a little bit more about the residual value risk in EVs that we've been working on with Upendra. They provide a sense of collateral and loss coverage that can back both individual loans, which are to date where a lot of guarantees have happened with individual loans, or portfolios of loans or bonds. This is what the green guarantee company set up to do, guarantees of bonds. And all of this without an upfront outlay of cash. So it's actually, that's part of the catalytic effect of it, right? These funders of guarantees don't have to outlay cash to begin with, only if the guarantees are called, only if they're needed. So it allows the beneficiaries of the guarantees to really benefit from the strong balance sheets and the credit ratings of the guarantors. And so overall, the impact of that is hopefully to incentivize lending, to broaden the universe of beneficiaries, and then also to improve the terms and conditions of the lending, so namely tenure and pricing. It's really important to note that guarantees, as Christina was mentioning earlier, if financial innovation is doing its work well, over the course of time, it's not needed anymore. So these guarantees can act as a bridge to actually creating a market. That means that there already has to be a business case for what the guarantees are supporting, right? It doesn't make sense if there's no commercial viability to the lending portfolio, to the end user assets that we're trying to support. So that's really important to keep in mind. And also that there is a lot of scalability to guarantees because it's not a permanent outlay of cash, right? The idea is that that cash gets recycled and then can be used to write new guarantees. So we put over here on the right side some of the key terms that are spoken about a lot and that really need to be fleshed out in guarantees and guarantee facilities. I'm not going to walk through all of them, but a lot of these have to do with where the guarantees lie in the capital structure, who's on the hook for how much when there's an actual loss on the loan. Okay, we can move on to the next one. So why are guarantees useful in this context? I'm going to speed through this because we basically just talked about it. But one of the key points I want to draw out on this slide is that guarantees can also really help enable the local financial sector. So that talking about that global north to global south, like this can really enable global south financial institutions to put their money to use, to have more credit support on their balance sheets, to venture into that perceived risk. And of course, there are some real risks as well of clean energy. And this especially can include maybe smaller or newer or more informal lending platforms, right? So this guarantee doesn't necessarily just need to boost the large financial institutions, the incumbents already in the country and in the sector. Again, these guarantees are meant to be temporary. So they're a bridge to market making data and transactions, right? Let's get more transactions into the space so that the financial institutions build the muscle of being able to lend to this space, get more comfortable with it. And there's just more data. So for the EV guarantees, we bridge to a time when there's more EVs on the road to actually understand the credit quality of these assets. Currency is also a really important factor here. One of the big hurdles to north to south and cross-border financing is the currency risk. So these guarantee facilities can be facilitated in local currency if we're working with local partners. So EVs in the global south, let's get a little bit more specific here. Very good use case. The business case is there. The total cost of ownership for EVs, I'm talking mostly about 2- and 3-wheelers in a lot of global south countries, the total cost of ownership is at parity or lower already than ICE vehicles. And that's because a lot of these vehicles are being used for livelihood purposes, deliveries, cargo, passenger purposes. So the more use they're getting out of the vehicle, the less money they're not paying for gas. So of course, this depends on the grid, and that's a whole different conversation, the cleanliness of the electricity in that country, but we'll save that for another time. So that being said, even though the TCO is at parity or lower in a lot of these countries, the upfront cost is still higher. So that makes it a really good use case for financing to come in. Again, the hurdles to the financing are solvable by the market making. So for EVs in the global south, there's not a secondary market. There's not a lot of standardization in product quality and product forms. There's a shorter track record for the vehicle performance, shorter track record for OEM performance. So all of that leads to, as I was saying earlier, less transactional data on these vehicles on the road, less supply chain confidence in the OEMs that could then support what we're going to be talking about with the residual values that feed into those loans. Another reason why EVs in the global south are a really important use case, and I'm using the word important on purpose here, is because they really lead into economic development, right? There's a lot of informal economies which are really supported by these delivery networks. And those informal networks, that informal employment can then start to turn into formal employment if we start getting ownership into the hands of the drivers and facilitating the fleet owners to buy more EVs. This is just a chart that's showing really the difference. This is just in India between the total cost of ownership on the left between ICE vehicles and EVs, and also the purchase price difference. I think this is really interesting. I didn't mention this earlier, but in India, there's been some regulation, some incentivization that has really supported the uptake of EVs as the FAME regulations that are being phased out. But that also really makes a difference, right? The regulation, the regulatory environment, and the incentivization provided by the government is a really important factor in all of this as well. Okay, so let's talk about the RV guarantee scheme that we're working on, and I'll ask UB to chime in as well. So this guarantee scheme is specifically focused on the residual value risk. How much, if the lenders have to repossess the vehicle or at the end of the life of the loan, how much can they get for that vehicle? There's a lot of uncertainty around that right now because there are not a lot of vehicles on the road. There's been like a first wave of vehicles in India, but we need more to build a robust secondary market. So the beneficiaries of this guarantee scheme will be NBFCs. There are a handful of new NBFCs, younger NBFCs, that are strictly focused on EVs and sustainability. And then there are now some incumbent NBFCs that are getting into EVs and sustainability. So the idea is to encourage both pools of NBFCs. And then, of course, the end user beneficiaries are the potential purchasers of 2- and 3-wheelers, especially those that really need to benefit from financing, that don't have already easy access to credit. And so let's try to prevent them from locking themselves in to a dirty ICE vehicle for the next 10 years, right? We have a chance right now when a lot of EVs are coming into the marketplace. So this next slide just talks about who are the key players in the guarantee scheme. We need a manager, we need the capital providers who will be at a concessionary rate until the money comes back, and then of course the lender beneficiaries. Energy Nexus and C-Kinetics, our role in all of this is that we're designing the guarantee scheme. We're finding and working with the guarantee manager to create the systems and reporting to implement the scheme, and then convening the participants, all of them. It's a big tent here that are going to be needed to implement this and actually make it happen. Make sure that there's uptake, make sure that the benefit gets to the people on the ground who want to buy EVs and operate their livelihoods through EVs. UV, I'm going to see if you have anything to add here.
No, thank you, Jennifer. I think for kind of providing the context. I think in our view, this is a very important innovation that is needed to ensure the momentum in the space can be maintained. Else, what is likely to happen is that new OEMs are unlikely to see enough uptake. Today, there is, even though there are 2 or 3 OEMs who may be under stress, causing a broader fear in the market. There is at least 4 to 6 new OEMs exploring e3-wheeler space as we speak. And it becomes extremely critical that they are able to inspire the financiers for those tie-ups to accelerate that adoption. And essentially, in absence of enough seasoned portfolio, you don't have a good benchmark for residual value, and therefore the perceived fear is what is likely to prevent. And it is natural that as a new market evolves, you will see a kind of a start-stop phenomena with some of the players. But the direction is quite well set. Year on year, we are seeing city-level new sale penetration turn extremely in favor of EVs. Even our taxation structures, including the recent announcements, have further accelerated that process. So we believe that this residual value guarantee outlook is critical. Now, one could always make a case that you could blend it with a broader credit enhancement structure. But what we believe is credit enhancement should respond to specific, point challenges rather than a very bundled offering. And therefore, we believe that credit underwriting per se, even to new to credit, should remain as it is with an ICE vehicle or others. And therefore, let the market take over similar to the ICE vehicle for the transition to, kind of pivot to scale. And which is where I think the delta is this residual value structure amongst other things. It doesn't mean this is the only problem to solve, but it's certainly a critical one to solve. And we can add more as we go along, Jennifer.
Thanks, UB. Yeah, I mean, we've heard until that lenders are basically assigning a 0 residual value to their loan. So, this is significant. Okay, Andrew, I think we can hand it back over to you.
Awesome. Great. Thank you guys for that and sort of giving Jennifer the high level overview of guarantees, but deep dive into a specific case study on this on electric 2-wheelers and 3-wheelers. One of my questions for the panel will be, and I could just actually stop sharing and just spotlight you guys for this, but are guarantees new? Like why now? Why are we seeing this more the uptick of guarantees, and what's the significance for clean energy as it relates to guarantee facilities? So who wants to take that?
Maybe I'll start. So no, guarantees are not new. And I think that's actually a really important point to make, that as we're thinking about financial innovation, we don't want to do everything new at the same time. That's a total no-no in finance. You want to build incrementally, because generally investment money doesn't want to see too much change at the same time and wants to be able to quantify and really describe the risk that it's taking for which it seeks reward. And guarantees, very, very established product. I'm a bit US centric. So if you look at the Small Business Administration, that's probably something that everybody's familiar with, SBA loans. That means small business loans, particularly for large asset financing, where the Small Business Administration has a program to work with small business lenders all across the US to guarantee those, so that if the bank just says, look, great small business, but these guys don't have any credit history and we don't know that they can actually make it work in the business, that they can turn to the SBA, the Small Business Administration, and say, do you think they have a good business plan? Are you willing to take that risk for us? And they might say yes. And that's generated so much economic development that this is a tried and true tool across many agencies, across large and small markets, both developing and emerging markets. So been there, done that for decades, and very proven structure. I'll leave the why clean energy to somebody else.
Yeah, no, just building on what Christina said, that I think even in the Indian context, if you look at it, guarantees have been around. We have the CGTSME, which is the principal guarantee mechanism for a lot of small business loans, and has been around. It's been a very successful program over the years. It covers some of the new age clean tech segments, including renewable energy, etc. The same guarantee manager also was piloting a small EV facility, couldn't scale up because it comes under the public sectors, which actually only validates why we need something like this, because it's a well-felt need. What we have done with the EVGF is essentially, as Christina said, identified a specific pain point to work with. You could have a broader credit enhancement for EVs as well, but we have chosen one which we believe is likely to be the most critical one for enabling new OEMs to scale up. And I think it creates a multiplier effect when it comes to impacts. Because in India, it's not just about getting the transition right, it's also about ensuring that it has a critical role in our GDP formation, and therefore the EV manufacturing value chain and enhancement there is a critical priority. And so I think that's one. And automotive is a sector that has been doing very well for India traditionally. So it's really about providing enough, I would say, building blocks for that to pick up, which is why this product becomes interesting overall. Again, I think with the guarantees, what is the role that guarantees are expected to play? Guarantees are essentially meant to augment what is already an investable project. It is not meant to replace bad credit. In certain cases, it could flip the case between a marginally bankable project and what is deemed as not bankable on a perceived risk dimension, or because benchmarks are not set up. But so that's why it is probably a very relevant product for EVs, where there is enough knowledge from the traditional vehicle financing, but because of the nature of the transition and the product's vintage, you would need another 3 to 5 years before some of the benchmarks will settle down. In about 5 to 6 years' time, you would have significantly evolved market where the need for this guarantee or form of this guarantee may be of a very different kind.
Jennifer, do you want to chime in on this?
Yeah, just really quickly, I would add that I think a lot of the guarantees that we've seen are bilateral guarantees rather than facilities. So facilities meaning pooling guarantees, that there's more than one guarantor. So adding parties on that end, or the other end, which is instead of just providing a guarantee to one company, we're providing guarantees to a sector.
Got it. That's super helpful, guys. And I'd love to sort of see how guarantees fit into the blended finance conversation. I was at AVPN, Asia Venture Philanthropy Network Summit last week in Hong Kong, and the blended finance capital stack is sort of top of mind these days, and it's different definitions and comes in different forms. What is the role of guarantees in the blended finance conversation?
Maybe I'll go first. I think we do have to say that blended finance is a buzzword, and it's fantastic and it's great, but it also has its flip side, which is whenever we talk about markets that are meant to function fully in the future, we need to make sure we have a way out of the blended finance stack for a totally commercially viable market. And I think what we've seen a lot of blended finance structures that work and that can transition out, but we've also seen examples of where blended finance structures do not create the effects to really transition into commercial markets. And the naysayers would say, you did it too early, you didn't do it wrong, you created the wrong incentive so that the commercial market couldn't sort itself out quick enough, and you actually may have done some market distortions. And I think that's where guarantees as a tool of the blended finance science can be really useful, because they're likely not to distort markets. They can disappear pretty quickly once a market works. And if they're never drawn on because the risk the risk doesn't materialize, then the market is functioning, the guarantee is still there in the background, was never called upon. That's success, actually, from a market perspective. So a very precise tool in that sense. You're already
I think from our experience, from the guarantees that we have implemented, we have done precisely what Christina has said, right? There is a stack which has a concessional pool, but that stack essentially is meant to allow for commercial crowding in because you believe the guarantee will not be tapped in, right? And if you've structured it well, then the market pricing overall allows for that facility to continue. The challenge in setting up those blended finance at scale is, where do you get that first loss? Because despite all the conversation, even if you look at MDBs, they are looking for that. We structured one in the distributed renewable energy, a very large facility with an MDB, and we were the ones who were supposed to work on getting that first loss pool, right? And so yes, blended finance, as Christine rightly said, is a broad label, can be applied in different forms. In case of EVGF, it could help, let's say, get the pricing in the right range in an initial adoption till the because if the pricing is benchmarked to the credit loss, perceived credit loss versus actual credit loss, but a guarantee manager is not comfortable with that number today because they believe the portfolio is not fully seasoned, then that is the role that it could play. But at some point, the market pricing has to take over, because if your credit loss is going to be X%, let's say 4-5%, you will have to provide for that, because that is what will pave the way for, let's say, securitization structures, pass-through certificates, etc., because that's the role that a credit enhancement pool is meant to create, because those benchmarks become critical for scale.
So I want to talk a little bit about the semantics of blended finance. So a lot of times blended finance is talking about one capital stack, right? One capital structure that has a couple of different components into it that then are made available to one pool or one, set of beneficiaries. That's versus catalytic finance. These are distinctions that I have in my mind. So a lot of the things that we're seeing with blended finance is that the ticket sizes are ginormous, and that makes it really hard to make them usable and affordable for especially borrowers or beneficiaries in the Global South. So what this facility is doing, it's kind of breaking it apart to say, we don't necessarily need to be part of this larger blended facility. And there are some really good ones that have just come out. The SDG loan facility, $2 billion, right? With a tiny guarantee in it, which basically enabled the whole thing by MacArthur Foundation. But what we're doing here is we're saying we're building this as a catalytic guarantee scheme that then can facilitate this loan from the NBSC, this loan from the bank. There's a little bit more flexibility around how the catalyzing can happen rather than being locked into this blended structure.
Got it. That's super helpful. Christina, maybe I can just double down on a point that you said, which is that if the whole idea is to cycle out, right, is sort of not create market distortions. Can you share anything in the past that where a case was like that it disrupted market dynamics effectively?
Yes. So I think we have seen some in the energy space and in other sectors, when governments want to be a venture capitalist, and they have launched large funds. There's a company that does this a lot. They're called Serona Asset Management. They arrange these facilities a lot, and they're large facilities so that large quasi-government entities can go in with both their venture capital like funding as well as some concessionary funding. And those deals tend to work for the fund one, that is the experimental fund, and they're really hard often to transition to a fund two at a multiple of the original size. That's where it seems to fail, because as soon as the subsidiary layer in a blended finance stack, whatever we call that, the first loss guarantee, somebody who wants lower returns, patient capital, all of that, what you're trying to do, the basics for blended finance is you're amalgamating people that have different return expectations for the money they're putting in, so that the blended rate is lower than what the market would currently pay for the risk without subsidies, right? That's the basic construct, and you can do that many ways. But you need somebody who's willing to put up their capital and wants less return, significantly less return than the market, so that it has an effect on that whole facility. And in those, we often see that when whoever that patient capital provider is and says, well, I did this for fund one, but now we've tested the market, we've piloted this should work. Let me pull out, you guys continue, you all existing investors at capital, at market rates, you guys continue, that momentum cannot be found because in these closed-end time-based structures, there isn't enough confidence yet. So that's where we've seen fantastic initiatives getting started that then don't turn into normalization in a commercial market scale. So that's sort of what I mean by market.
That's helpful.
And we see that smart in small places too. Like I've seen that in the cook stove world, for instance, where there's sort of a notion of let's also just sell product below price to instigate the market. But it's you create fake incentives that then peter out when you're trying to make that a normal product. Anyway, I'll stop there. UB.
Yeah, no, I think a segment which saw this in bits and pieces in several markets was the mini grid market, right? Where you kind of brought an intervention to match up to make it investable, supposedly, because you seen it as an infra solution, but the financiers were not seeing it as infra because you were still not sure about the offtake mechanisms, etc. So you ended up creating momentum somewhere, if you go back about a decade, there were several mini grid players in several parts of the globe. Very few have survived, and they survived on the back of partly financial engineering, but also bringing in some sane decisions around their own models and the segment diversification they were able to bring. So I think there is always that risk. And I think governments have a tendency to kickstart markets with concessionality. And if you're not able to aggregate enough demand in a market, then that concessionality becomes a permanent prerequisite. And yet the system's priorities have evolved. And so you end up perhaps destroying a segment, rather than enable its growth. And I think it's not specific to one country. You could see several repeat examples on the back of development financing support. Well-intentioned, but just not, because it doesn't last for that long, Andrew. So if you could outlast the vintage needed, then you wouldn't have a challenge. Because slowly the market will start responding to it with the requisite demand. But that doesn't happen.
That's great articulation, UP. Quick follow-up question. Is this model scalable across countries?
Absolutely. I think you will have the need for this in several markets. I think the principles will be similar. Obviously, the nature of the financing ecosystem varies. The mix of financiers varies, so you will see variants to this. But I do believe you could easily see 6 to 8 countries where the ecosystem is reasonably right to take this forward. And like I said, at a segment level, there may be variants to this, etc. But I think electric mobility as a product has evolved substantively in the last 3 to 4 years. And I think in the next 3 years, innovations of this kind will allow it to kind of mainstream itself. And in about 5 to 6 years' time, you could actually start sunsetting parts of it or evolving it morphing it into a different form. That's my take. I don't know, Jennifer, Christina, if you agree.
I would say also guarantees themselves as a scheme, as a facility, are definitely scalable. What we've learned in exploring multiple markets is that it's really important to understand the financing landscape. Who are actually the lenders? Who are actually the ones who have access to the drivers? NBFCs in India are the ones that drivers and owners are going to for their loans, but that's not the case in Southeast Asia, for example. So if we want to get uptake of the guarantees, there are some guarantee facilities out there that just don't have great uptake. We really have to understand the local landscape and who is it that the drivers are going to and interacting with. I think, and some of these points are under success factors on one of the slides, if you all want to refer back when you receive them. But also, I think education and technical assistance for the beneficiaries is also important, because there's going to be some education, not only on, if we talk about EVs again, the benefits of EVs, but also on how to access this guarantee scheme. Sometimes it's a new concept. So especially depending on who the guarantors are, who may have certain requirements or application processes. So pairing the financial support with the technical support to say, this is how you can access the guarantee facility. Let us help you with your loan portfolio and how this can look to actually make it sustainable.
Thanks, Jennifer.
And
Quick
at the
time
same
check.
time, I would add that vehicle finance in itself is such an old concept. Like, that's so easy to understand. And I actually think for guarantee schemes, that's, again, it's important. There needs to be a mental market model that's clear. Like, we don't have to explain that financing is needed to finance contraptions that get people and cargo from A to B. That's out there. So we do also have benchmarks and comparisons that allow the risk quantification. I'll stop there.
Great, thank you. And maybe one last question before we go to Q&A is how does fit into New Energy Nexus's work as an ESO? And then sort of a
I think that's probably a question.
self-plug.
Yeah.
Yeah, Jennifer, over to you.
Yeah. Yeah, so a lot of what we're doing is not just supporting existing entrepreneurs and markets that matter for the energy transition, but also building the ecosystems that they need to thrive. So just tell the money, right? The money part of the equation is really important. Like, how are they going to market? What are the markets that the entrepreneurs are serving? So essentially, these guarantees and financial innovation in general is just saying, we're not just going to look at one component of supporting entrepreneurs. Let's build the ecosystem that they need to not just survive, but thrive.
Love it, Jennifer. So we can move over to Q&A since we have 14 minutes left. I want to get to a question from one of the audience members, Oswin. What would be the total corporates under the guarantee program? Also, could you provide some guidance on the timelines by when the program would be taking place?
So I can start and UB can correct me. So for this residual value guarantee scheme in India, we're looking at something in the range of like 40 to 60, 70 million as the guarantee pool. That could then, we think, catalyze, let's say, up to 10 times the loans. Timeline, let's say next year, mid next year sometime. Okay, and this is where UB can correct me.
No, I think you have the right outlook on the timeline and the numbers. I think, Aswin, this is obviously an evolving market, and you have seen significant scale to start emerging. We have actually now about 15 odd green EV specialist financiers with portfolios north of about $15 million on the retail side. At least 10 of them have certainly that kind of ongoing AUM. They have done more loans. Some of them are revisiting some of the segments, etc. The largest one, and I'm talking not the traditional incomers, these are people who essentially came in the last 3 to 5 years, right? And the largest one now is somewhere in the north of about $40 million portfolio, right? Within the segments of interest. This does not include e-buses. This does not include four-wheelers, etc. This is just the two segments that Jennifer, and in fact, bulk of it is still the, what you call as the three-wheeler segment. Little bit of two-wheelers, because two-wheelers from a pricing point of view, several banks are equally attractive. And then you have within the traditional guys, another 6 to 8 guys who have really started transitioning really well on this. And so we are quite confident that you could do justice with this size to the market. And then depending on the uptake, based on all the good factors that Jennifer was referencing, you could see a scale up happening. In our conversations with both prospective guarantee manager partners as also guarantee providers that they've worked with. There seems to be interest. The question would be, how do you make all the conditions work, particularly the pricing, etc., to get it off the ground? And I think that's the piece of work which is cut out for us for the next 60 to 90 days.
Thanks. That's super helpful. Just looking in the Q&A section here, we have a question on, and I love this question because this is something that is deep in sort of the work that we're doing at Nexus, which is, what is the role of philanthropy and guarantees to advance the Global South energy transition? So who wants to take that?
I can start. I love this question too.
Yeah.
So I think there's a number of ways. We all know that philanthropy has limited capital, right? So how do we really catalyze that capital to make an impact? So the two main ways are, number one, being a capital provider, being a guarantee provider. There are things called just pure philanthropic guarantees where there's no fee taken, they're unfunded, they're basically earmarked to be called upon if needed. The guarantee scheme that we're working on has a fee associated with it. So this could work for, if there's a foundation that has an investment arm, it could also work for that arm, the endowment, right? The other side is, of course, providing operational funding for, here's the plug, for groups like us to get this off the ground, to fund the work to build these facilities. So that's the operational grant funding and then the capital provision within the guarantee structure.
And I think we shouldn't underestimate the role of philanthropy to be able to convene as well. I think it's sort of I want to call it a housekeeping stamp of approval, right? But I think a lot of philanthropies today have very strong theories of what they want to invest in and tend to do so in peer groups and have very rich discussions around that. So I think philanthropy can play a role in there too.
Great, thanks, Christina. All right, we actually have some time left, and anybody else want to type in their questions in the Q&A? Just give it a minute.
Or comments.
Oh yeah, or comments. If no comments, I kind of just have a question maybe to all the panelists, which is really like, we've deep dive into guarantee facilities, blended finance capital stacks, but like high level, 10,000 feet, like what does success look like for you guys in financial innovation at this moment? 5 years from now, where do you want to be? What does that success look like?
Let's start. So I think as New Energy Nexus, as a nonprofit, we have a pretty unique role to play in seeing the various risk rewards profiles of the capital providers, of the investors that are potentially interested in clean energy and the climate space. So that means that we can do things like build these types of facilities, just really taking an objective view of what's needed in the market. We can do a lot of convening because we have contact points into lots of different types of organizations. So I think what we can do in financial innovation, in addition to these types of guarantee schemes, is also play a role of convening, of aggregating, of connecting investors with solutions. I think there is a gap right now that is missing a facilitation piece, where there's companies, solutions looking for funding. There's investors who say, I need investable solutions. I can't find investable solutions that meet my size requirements, my ticket size requirements. And then they just say, okay, that's it. So can there be a facilitation role that we can play that says, okay, well, if you can't match this, maybe you can match this part of it. Again, it doesn't have to be within a blended structure. It could be within a catalytic structure that says, let's not just say no. Let's figure out What's the real risk? What's the perceived risk? How can we bridge those things? How can we bring in mitigating factors like guarantees? Christina?
Yeah, and I would add all of what Jennifer said. And I think if we take the really long-term view, at the end of the day, we need to that the conversation needs to stop that clean energy or e-mobility or renewable energy, whatever we're going to call it, is something special, right? And therefore needs special products and special treatments. We need to, like, it's the continuous mainstreaming that the consumer has a choice. Hopefully they all choose EVs, right? But that the choice of having an EV, choosing an EV is not a barrier at the point of financing, or the choice of wanting to have your home solar system. It's not, doesn't make you financially worse off than consuming dirty energy. Like, that's sort of the more conversations we can have to also advance that mainstreaming and sort of take the fear factor out of anything that is a renewable clean energy product. That it just needs to, it's going to be our future energy landscape. It's going to be our future energy source. And it needs to be, we need to get to the point like we were in an unenlightened fossil fuel economy, that energy is part of infrastructure, and it's just there, and not so special. If I can say that one. UB?
Yeah, and I would like to put this a little differently. I think from what we see, this transition is going to happen across several kinds of interventions. We are seeing renewable energy as one, we are seeing electric mobility. They follow the same principles, essentially, that you will have a tech which needs to kind of stabilize, and then the unit economics need to come together. And I think at that point, you need to trigger a sense of adoption. And essentially, this process of discovery of that and getting it past the inflection point is where I think C-Kinetics and our financing arms, Seekers Finance, really looks at success from that dimension. We are very happy building out interventions which allow you to take it past the inflection point. And if mainstreaming has happened, we are happy to vacate that, because I don't think, so I think that's the outlook with which one would look at this.
Thanks, UB. Appreciate that, guys. We have one more question that just came in, actually, too. We only have a couple minutes left, so we can get some quick responses. For Marie, when you envision the residual value scheme, how will you determine the backstop residual value price of the EVs? Do you plan to support buybacks through the facility, or what will the facility be offering in terms of loss coverage for the fee that you speak of? Quick responses, please.
I can go quickly, and then you can chime in. So there are 3 questions there, and I'm not surprised that Marie has the deep knowledge to ask these questions. Thank you, Marie. So the residual price, yeah, that's a great question, right? There's enough there, and I don't know about enough, but there's data on the roads from the first wave of vehicles that are out there. So there is data that we can tap into to first create a theoretical residual value. Number 2, yes, so part of the facility will be also to bring in this component of matchmaking with second life, recyclers or second life battery producers. So facilitating that connection so that we can start to actually help make that market. And then the loss coverage. So this is under negotiation and in discussion that UB is having with folks on the ground, but probably something like in the 80% range.
Okay. UB, anything to chime? One final question.
I think Jennifer gave the salient aspects of this, but I think when it comes to residual value, you have also the traditional vehicle finance benchmarks. Because in an ideal state, that's where you want to take this market over the next 2 to 3 years, right? And that allows you to kind of start framing a conversation on both sides. And yes, there is a role for buybacks because the repossessed vehicles would need to, and that's part of the ecosystem build out we are doing to complement this. There are already specialists who are emerging, and with the right set of tools, we believe you could address this, or at least that's the indication we are getting from some of these partnerships.
Great. 2 minutes left, guys. Last question, if we can just quick response. What are the challenges you have come across or envisioned while mobilizing investors for this platform for the intended borrower or beneficiaries?
Well, I think UB can speak to the challenges he's already facing.
I think the primary one obviously is when you want to start something new, everybody wants to join in, but not the first one to kind of kickstart it. So we are at that phase, but I think we have got some interest, frankly, to work it out. The question would be balancing the price of the guarantee that the financiers are comfortable absorbing without thinking that this is only works with a runaway loss versus what would make commercial sense, because we are designing it with commercial guarantee providers with that outlook and with that set of providers. So I think we are at that stage of how to balance that. And that's where, we talked about that in initial, do we really need consistency? How do you make that pricing work? Do you taper it off? And we have put some salient aspects of tapering off in the guarantee product itself, both in terms of as the loan vintage evolves, but also in terms of what the OEM or the financier needs to kind of step up to and what the OEM needs to step up to.
Great. Thank you, UB. We're out of time, and this just wraps up our financial innovation webinar. First of all, big round of applause. Jennifer, UB, and Christina, thank you guys. This was an incredibly fruitful discussion with very in-depth questions. So if you guys want to follow up with New Energy Nexus, feel free to reach out to Jennifer Wong, Director of Financial Innovation, or Christina and UB from C Kinetics. Do find them on LinkedIn. And I think we could provide emails in the follow-up, yeah? So that shouldn't be a problem. And look forward to seeing you guys for future webinars. We try to host one every month to talk about our various programs, products that we're running in the markets around the world. So do tune in to our New Energy Nexus LinkedIn, as well as our other social media platforms. Thank you guys so much for your time today, and we'll see you next time.